G'day, folks! After sitting down with my dad, my aunt, my uncle, there's this really interesting conversation that will always arise about stock market investing, and I find the same misconceptions come up that so many of you have been asking me about in that comment section below, whether it's about tax-advantaged accounts, currency conversions, or how to, damn it, even properly diversify a portfolio. This isn't investment advice, it's just one Canadian's opinion, but this will be a video for the ages, and if that's a conversation you'd appreciate, hit that like button, folks, because let's get right into this with a comment coming from ValveMan12 saying, "Great info, Kyle. I'm big into dividend investing and have been doing so for over a decade. The TFSA is a gift, in my opinion, a gift from God, and I'm so surprised how many people never contributed to it. In my opinion, a TFSA is an incorrect label. This account should not be considered a savings account, but instead an investing account, and should be renamed a TFIA, a tax-free investment account." And I do 100% agree, because my favorite saying on the planet is tax-free income in perpetuity for the rest of your life. Talking to my family, I realized just this very thing, that my family's using this account as a savings account. They weren't even investing in it, damn it. And if you're a newer, younger investor, don't make that mistake. This is life-changing stuff. The way a TFSA works, just to reiterate, I'm sure many of you are aware, you earn money, you pay tax. You're allowed to contribute a certain amount each year to this account, which you can see the contribution limit on your CRA account. Once you put the money in the account, guess what? You can invest it tax-free for dividends, cap gains, in perpetuity for the rest of your life. You can draw against it whenever you need it. Don't pay any tax. It's a beautiful thing. I got like 160 grand in here. Look at these gains that I'm starting to get here on VDY. I mean, my TSM position, I could sell all of this tomorrow, use it to buy a house or whatever I need, and it wouldn't affect my tax bracket. All this stuff is just super awesome, and I use this as a backup emergency fund. If I want to draw against these dividends, I can at any time. Don't have to touch the investments. It's a great way of long-term investing. But where the most misconception comes in is with the RRSP. This is mine here, and my uncle recently just retired, and he feels really annoyed that every time he draws money out of this account, he has to pay tax on it. But I had to remind him, hey, in contrary to a TFSA, you earn money, you pay tax on that money. But if you put it in this account with whatever your contribution limit is, you'll get a tax refund. This is a tax-deferred account at which you can make dividends and cap gains tax-free for as long as it's in this account, at which you can draw against it any time. But be aware, when you do, that's when you pay the deferred tax. It's still a wonderful investment and vehicle. And unlike the US with the Roth IRAs and 401ks, you get penalized for drawing against those before retirement. But these two accounts, you can draw against whenever you want. They're beautiful, beautiful tools, and you should max these every damn year. Leading into another question from Chris B saying, how do you go about converting to US? That's my issue with buying VOO instead of VFV. These two investment vehicles in Canada are very, very popular because VFV is like the already converted version of VOO. Now, VFV has actually been outperforming VOO. Over the past 5 years, it's up 57%, whereas VOO is only up 46%. Why is this? And then I'm going to talk about currency conversion. Well, first and foremost, the US dollar has been rallying aggressively against the Canadian dollar. Over the last year, if you bought US dollars, even though the US dollar is dropping a bit against cash, you'd be up 4.4% without investing any money. So just think about that. If you just converted your currency to USD, you'd be up 4% on the last year. It's kind of a wild thing to try and wrap your head around, so I don't try and do that. I really like the US dollar and investing in the US economy, and a lot of people get up in arms about having to convert currencies. You'll see my tax advantaged accounts, I already have that money converted, and I actually make dividends. You can see I have US income here, and I leave it in US dollars because you can spend US dollars in Canada, you can spend them globally. You don't really have to convert it that much, but people get up in arms because you pay like 1.5% to 2% converting currency. But let me tell you, is it a big deal to really pay 2% on an initial conversion if you were buying Apple stock? I mean, when you're up 258% in the last 5 years, does 2% on a conversion really make that big of a deal? In my opinion, no. That's why I've separated most of my income from 50% Canadian and 50% US, and I utilize both those currencies in my daily life without converting them back and forth. But if I want to buy more US stocks with my Canadian income, I'll just convert it. I don't really care about it. I think people just kind of over dramatize this, and it's just something I think every investor should do, is have multiple currencies in their portfolio. But again, if you don't want to deal with the headache, you can always just buy VFV. Some stocks in Canada offer that immediate conversion within the actual stock itself, which is kind of cool, right? Now, Mike asks an intriguing question. Do you look at anything besides dividends? Enbridge is saddled with debt. Shopify has almost non-existent EPS growth and a PE of 385. Bear with me. This is going to be a long-winded answer. This is just one Canadian's opinion, not financial advice, because there's no one size fits all for investing. But in the influencer realm, there's people like PPCE and passive income investing, these guys that focus on really high dividend yield investing, which I think is better for somebody perhaps at a retirement age, because if you're younger, you don't want to focus on high yield dividend stocks, real estate investment trusts, things like Enbridge. These are companies that can't really see high rates of return on investing their own capital, so they decide to pay it out in a dividend instead. If you're younger, you really need that long-term potential growth, so you can't fixate on dividends, or I promise you, you're going to dramatically underperform the market. And I suspect both of these investors are dramatically underperforming because the investments they hold, as I've monitored them, they don't do very well against the broader indexes. But if there's one investment philosophy I love to follow, because I don't consider myself a dividend focused investor, I talk about dividends a lot. It's a big proponent of my portfolio, but I don't buy anything that can't offer long-term growth as well. And Dave Ramsey has this really incredible philosophy on these buckets of investing you can follow. Though he recommends mutual funds, I don't like that. I still think you can implement this fund strategy into your own investing style. So we have growth and income, growth, aggressive growth, and international. 4 buckets. Growth and income, these funds create a stable foundation for your portfolio. They can be described as large, well-known, big and boring American companies or Canadian companies. So things like Procter & Gamble, Home Depot, or things like Toronto Dominion Bank or Royal Bank. But then we have growth. This category features medium or large US companies that are experiencing growth. Unlike growth and income funds, these are more likely to ebb and flow with the economy. For instance, you might find these companies making the latest gadget or luxury item, so your Teslas, your Amazons, and your Shopifys. Then we have aggressive growth. Think of this category as the wild child of your portfolio. When these funds are up, they're up a lot. When they're down a lot, they're down a lot, but these are kind of like your small caps, right? And then we have some international exposure. And I think these buckets will dramatically depend on your age, how much you're going to put in each. If you're younger, I don't think the value of Tesla or Shopify matter very much if you're 20 years old. You could buy those, hold on to them for decades, and get that value to bake in over that long period of time and get that exponential growth. Whereas if you're in your 40s or 50s, you don't want the volatility of Tesla, not understanding, the value and where it could be at the next 5 to 10 years. So you're going to focus more on bonds, GICs, dividend-focused companies, perhaps like Enbridge or REITs. But just taking a look at how I've managed these buckets and how I see it from my risk tolerance and perspective, in my portfolio, I've got my Canadian ETFs like VDY, I've got things like my US exposure in VOO, SCHD, my international exposure, which is something I think I desperately needed with the likes of TSM, and then I got the wild child side of my portfolio with these small cap companies. So let's just take a look at this, because on the international side, I consider this to be growth investing. Though TSM pays a dividend, it's primarily been a growth beast over the last 5, 10, since its inception. The semiconductor industry is booming, and it's really awesome that this growth stock not only trades for a decent value, but has a decent yield of around 2% that's been growing really well over its history. So that's my foreign exposure. The wild child side, I hold small cap companies, private placements that aren't publicly traded yet, higher risk. These kind of come with higher reward, but I don't weight them very largely in my portfolio because at this age, I don't want to deal with the volatility and the risk. So that would be things like a Duro Clean Technologies. I have a small investment in this really neat small cap company. But taking a look at those other baskets, I really consider VOO and SCHD to be a combination of growth and income. The Schwab US Dividend Equity ETF pays over 3.5%, and the performance has been stellar, to say the least. If you invested $10,000 in this ETF in 2013, 10 years ago, you'd be worth $35,000 today. I don't think you could ask for that to be any better. And in the Canadian markets, guys, I own things like VDY. Now, this is more income oriented, but I don't look at any ETF or any investment anymore that can't over double my money over a 10-year basis and pay, a decent or at least some form of a dividend yield, right? So in this ETF, yes, it's up about 80%. So it's almost doubled my money in the last decade. But if we take a look at the cumulative return, so this includes dividends and growth, we can see if I invested in this back in 2013, today I'd have around 24,000. Yeah, it's not as impressive as VOO. It's not as impressive as SCHD, but being a Canadian, I like investing in the backbone of the Canadian economy, which, yes, historically has underperformed the US, but that's why we diversify to get a balance of everything, because VDY pays me that really high yield, whereas VOO, TSM, they don't pay that high of a yield. Same with my small caps, right? So the overall yield on my portfolio is 3%, and that is a very happy medium for me because I can reinvest those dividends, I could spend it as an emergency fund, and I wouldn't be hindering the long-term growth of these investments. And I think that's the best investment style for me at this point, and I think I really take into consideration all the baskets that Dave Ramsey mentions. But at this point, folks, if you do want to learn more, I talk way more privately, unsolicited, unsponsored over at my Patreon account, where there's things that I'll never talk about on this YouTube channel. I had a family emergency over the weekend, so I couldn't post anything, but I have been adding some updates around my corporate account. I've been talking about the untold stories of my personal finances, how much money I make, how I make that money. And if you want to support this channel, continue the journey with me, consider going over to my Patreon. It's $5, guys. It's less than a Starbucks coffee a month. But let me know what you think in that comment section below.